Most retirees believe the IRS exists to take as much of their money as the law allows. But if you actually sit down and read the tax code, the way I have been doing for weeks now, you find something that almost sounds made up. There are entire sections of federal law written for one purpose, to pay you for putting your money into certain things. Not loopholes, not gray areas, not aggressive schemes that get shut down a year later. Real, permanent incentives that Congress wrote on purpose. Because the government wants ordinary people to invest in housing, in tax-free income, in their own future, and in their family's future. And it is willing to hand back tens of thousands of dollars to anyone who does. Over a full retirement, and especially once you count what eventually passes to your children, the right combination of these can legally keep more than $100,000 inside your family that would otherwise have gone straight to the Treasury. And the reason most people never claim a single dollar of it is simple. Nobody ever told them that the tax code is not a punishment. It is a menu. Congress put a long list of rewards on that menu, and you only get them if you know to order them. In the next 25 minutes, I'm going to walk you through the 4 things the IRS will quietly pay you to invest in, exactly how each one works, and the real numbers behind them for 2026, plus a handful of bonus moves at the end that almost no retiree ever uses. Nothing in this video is financial or tax advice. Everyone's situation is different, so talk to a credentialed tax professional before you act on any of it. Let me start with the single idea that makes everything else make sense, because once you understand it, you will never look at your tax bill the same way again. The tax code was not built to be fair. It was built to steer behavior. Every line in it is Congress trying to push money towards something it wants more of. More rental housing, more small business, more retirement saving, more charitable giving, and the way it pushes is simple. If you do the thing the government wants done, the government pays part of the bill for you. If you just collect a check and do none of it, you pay the highest effective rate there is. That is the entire game. The people who keep the most of their money in retirement are almost never the ones with the fanciest accountants. They are the ones who figured out that the code is really a list of rewards, and then they went and claimed the rewards. So let me show you the 4 biggest ones a retiree can actually put to use. The first thing the IRS will pay you to invest in is real estate, and I want to spend real time here because this is where the tax code gets almost embarrassingly generous. And it is something a great many retirees are in a position to do. When you own a rental property, the IRS lets you take a deduction every single year called depreciation. Here's the idea behind it. The tax code assumes that the building slowly wears out over time, so it lets you write off a piece of the building's value against your rental income each year. For a residential rental, you take the value of the building and spread it over 27.5 years. So a rental with, let's say, $275,000 of building value hands you roughly $10,000 of depreciation deductions a year. Now here's the part that makes people sit up straight. In most years, that building is not actually losing any value at all. It is going up. So you are collecting rent, you are watching the property appreciate, and at the very same time, the IRS is letting you treat it as if it lost $10,000. Which wipes out the tax on a large chunk of your rental income. Picture a rental that nets you $12,000 in a year. With $10,000 of depreciation, you are taxed on only $2,000 of it. The other $10,000 comes to you with no tax at all. People call this a phantom loss, a loss that exists only on paper while the real asset is quietly gaining value in your hands. It is one of the most generous arrangements anywhere in the entire code, and it gets stronger. There is a strategy called a cost segregation study, where an engineer goes through your property and identifies all the pieces that wear out faster than the building itself. The carpeting, the appliances, the light fixtures, the landscaping, the driveway, and lets you write those off much faster, front-loading a big deduction into the first few years of ownership. And here is something most people have not caught up to yet. As of the 2025 tax law, what is called bonus depreciation is back to 100% and has been made permanent. That means cost segregation is more powerful right now than it has been in years. A retiree who buys a rental and does this correctly can sometimes shelter most of that property's income for the first several years entirely, paying little or no tax on it while the property appreciates underneath them. Then, there is the part the wealthy have quietly used for generations, the 1031 exchange. Section 1031 of the code says that if you sell one investment property and roll the entire proceeds into another investment property within a set window of time, you do not pay a single dollar of capital gains tax on that sale. And you are allowed to repeat it again and again. You can trade a small rental for a bigger one, then a bigger one for a bigger one after that, deferring the tax every single time you move up. Imagine buying a rental for $200,000, watching it grow to $400,000, and instead of selling and handing the IRS the tax on that $200,000 gain, you roll the whole thing into a larger property and owe nothing. Now here is where it all comes together, and this is the piece that matters most for a retiree. When you hold those properties to the end of your life and pass them to your children, your heirs receive what is called a stepped-up basis. Every dollar of gain that built up over all those years, all of it, is wiped clean for tax purposes. Your children inherit the property valued at what it is worth on the day they receive it. They can sell it the very next week and owe nothing in capital gains. So follow the whole arc. You collect the rent. You shelter the income with depreciation. You defer every gain with the 1031 exchange. And at the very end, the entire lifetime of built-up gain simply disappears for your family. That is not a loophole somebody snuck in when no one was looking. It is written plainly in the code. And it is exactly the combination that builds real estate wealth across generations. I will be honest with you, though, real estate is genuine work. It carries real risk. Tenants and repairs and vacancies are all real, and the rules on how much of those losses you can use against other income have limits. So this is one to walk through carefully with a professional before you ever jump in. But for the retiree who wants it, the tax treatment is among the best in the entire code. The second thing the IRS will pay you to invest in is tax-free income, and for a retiree this one is quietly valuable, though I am going to be very precise with you about exactly how far it goes. Here is what the IRS does with municipal bonds. When you lend money to a state, a city, a school district, or a local government by buying their bonds, the interest they pay you back is exempt from federal income tax entirely, not reduced, exempt. And if you buy bonds issued in your own state, the interest is very often free of your state income tax too. So you are earning income, and the federal government simply chooses not to tax it. For a retiree who wants steady income, that is a rare and valuable thing, an investment built from the ground up to be tax-free. Imagine a retiree holding savings in an ordinary taxable account, where every dollar of interest gets taxed as ordinary income year after year after year. Move that same money into tax-free municipal bonds, and the interest now arrives with no federal tax bite at all. Now here is where I want to be precise, because precision is the whole point of a channel like this. Tax-free municipal interest is free from income tax, but it does still get counted in the formulas that decide how much of your Social Security is taxed and what you pay for Medicare. So this is not a secret way around either of those two things, and anyone who tells you it is does not understand the rules. What it genuinely is a way to earn income that the IRS does not tax directly, and over a retirement that adds up. And there is one more thing to understand. Because the income is tax-free, the yield on a municipal bond is usually a little lower than a comparable taxable bond, which means this move pays off the most for retirees in the higher tax brackets, where the tax you are avoiding is worth more than the small bit of yield you give up. For the right person, in the right bracket, it is income the government has formally agreed not to touch, and there are not many of those. The third thing the IRS will pay you to invest in is your own tax-free future through the Roth, and the way a retiree builds it is one of the most powerful single moves in the entire code. Here is the setup. Most retirees have the bulk of their savings sitting in a traditional IRA or a 401k, which means the government is still a silent partner on every single dollar in there, waiting to tax it on the way out. And starting at age 73, the IRS forces money out of those accounts whether you need it or not, which can push up your income tax, push up how much of your Social Security gets taxed, and push up your Medicare premiums. All at the same time, the Roth flips all of that on its head. Money inside a Roth grows tax-free, comes out tax-free, and is never forced out during your lifetime. So how exactly does the IRS pay you here? In your lower income years, often that stretch between when you stop working and when those forced withdrawals begin, you take money out of the traditional account, pay the tax on it at today's low rate, and move it into a Roth. You are voluntarily paying a small tax bill now to escape a much larger one later. Picture a couple in their late 60s living on a modest income before their required withdrawals start, sitting in one of the lowest tax brackets they will ever see for the rest of their lives. By moving a chunk of their traditional IRA into a Roth each year at that low rate, they do four things at once. They shrink the forced withdrawals coming at 73. They lower how much of their Social Security gets taxed for years to come. They build a pot of money that will be tax-free forever, and they protect the survivor. Because here's a piece almost nobody thinks about. When one spouse passes, the other has to start filing as a single taxpayer, and the brackets for a single filer are far tighter, so the same income suddenly gets taxed at a higher rate. Having more of the money already in a tax-free Roth softens that blow enormously, and when the Roth eventually passes to the children, it comes to them with no income tax attached. Done patiently across several years, the total tax avoided by a strategy like this very often runs well into six figures over the course of a retirement. The one real rule to respect is to convert only enough each year to fill up your current low bracket without spilling over into the next one, which is exactly the kind of thing worth mapping out carefully with a professional before you start. The fourth thing the IRS will pay you to invest in is the health savings account, and I call it the quiet champion of the entire tax code, because it is the only account in the country that gives you 3 separate tax breaks on the very same dollar. Watch how this works, because it really is unique. 1. The money you put in is deductible, so it comes right off your taxable income in the year you contribute it. 2. The money grows completely tax-free while it sits there, with no tax on the interest, the dividends, or the gains. And 3. When you take it out to pay for qualified medical expenses, that withdrawal is tax-free too. In goes tax-free, grows tax-free, comes out tax-free. There is no other account anywhere in the code that gives you all 3 of those at once. For 2026, you can put in up to $4,400 if you have self-only coverage, or $8,750 for family coverage, plus an extra $1,000 if you are 55 or older. Most people treat this account like a little spending account for this year's doctor visits, in and out, and they miss the entire point. The real move is to leave it alone, let it grow and compound for years, and treat it as a tax-free medical war chest for later in retirement. When medical costs are the one bill you can be almost certain you will face. And here is the part almost nobody knows. Once you reach 65, the HSA quietly turns into something even more flexible. You can still pull money out tax-free for medical costs, but you can also pull it out for anything at all, and it is simply treated like a traditional retirement account with regular income tax and no penalty. So it becomes the best of both worlds, a tax-free account for medical bills and a backup retirement account for everything else. The one catch to understand is that you can only put new money into an HSA while you are covered by a qualifying high-deductible health plan and not yet enrolled in Medicare, so the window to feed it has real limits. But for anyone who can still contribute or who has one sitting from their working years, it is the single most tax-advantaged dollar you will ever own. Now those are the 4 big ones, but I promised you some bonus moves, because there are several smaller rewards sitting right there on the menu that retirees walk straight past, and any one of them can be worth thousands of dollars a year. Let me give them to you quickly. Bonus 1, the qualified charitable distribution. If you are at least 70 and a half years old and you give to charity, even a little, you can send money straight from your IRA directly to the charity, and here is the magic of it. It counts toward your required withdrawal for the year, but it never shows up as income to you at all. And unlike the municipal bonds we talked about, this one genuinely does keep your income down, which protects your Social Security taxation and your Medicare premiums at the very same time you support your church or your cause. For a charitable retiree, almost nothing in the code beats it. Bonus 2, the 529 to Roth rollover for your grandchildren. If you set money aside in a 529 education account for a grandchild and they do not end up using all of it, recent rules now let up to $35,000 of that leftover money roll into a Roth IRA in the grandchild's own name. So you fund their education and quietly seed their retirement, tax-free at every single step, and not $1 of it goes to waste. Bonus 3, the 0% capital gains bracket. In a low-income year, a married couple can have a meaningful amount of taxable income and still pay 0%, and I mean a true zero, on their long-term capital gains. A retiree in those gap years before required withdrawals begin can deliberately sell appreciated investments, pay no federal tax whatsoever on the gain, and reset their cost basis higher so they owe less down the road. The IRS is literally letting you cash in your gains at no tax at all in the right year, and most people never realize the window is open. Bonus 4, the Augusta Rule. If you run any kind of small business in retirement, even a little consulting or a small side operation, you are allowed to rent your own home to your own business for up to 14 days a year, collect that rent, and pay zero tax on it personally. It is one of the cleanest small rewards in the whole code for the retiree who has a business of any kind. So let me put it all together now, because this is the part that changes how you think about every dollar you have. Because this is the part that changes how you think about every dollar you have. Picture a retiree who owns one rental property and lets depreciation shelter the income year after year, saving a couple $1,000s in tax annually. Who moves a chunk of taxable savings into tax-free municipal bonds and stops paying income tax on that interest entirely. Who spends their low-income years steadily converting their traditional IRA into a Roth at a low rate, draining the future tax bomb a little more every year, and quietly saving a six-figure amount in lifetime taxes. Who has been growing an HSA into a tax-free medical reserve worth tens of thousands. And who, every year, gives through a qualified charitable distribution and harvests a few gains at 0%. None of those is exotic. None of them is a scheme. But add up the sheltered rental income, the tax-free interest, the lifetime tax saved on the Roth conversions, the triple tax-free HSA, and the gains cashed in at zero across a full retirement, and then add on top of it all the capital gains that simply vanish for your children through the step-up at the end of your life. For a household with real assets, the total the IRS quietly hands back or simply agrees never to take very comfortably clears $100,000 over the course of a retirement, and often runs far higher once you count what passes to the next generation. That is not a fantasy number. That is just the code working exactly the way Congress wrote it for the people who bothered to read the menu. And here is the thing I keep coming back to after all these weeks of digging through it. The retirees who use these are not richer or smarter than the ones who do not. They simply found out the rewards existed while there was still time to claim them. Almost every one of these has a window, a low-income year, an age threshold, a deadline, and once that window closes, it does not come back around. The tax code is sitting there right now, full of incentives with your name on them, waiting for you to order off the menu. Most people never do. Now you can. If this video was useful to you, the most helpful thing you can do right now is hit the like button, because that is the single signal that tells the YouTube algorithm to put this in front of more retirees who need to see it. Subscribe if you have not already, so the next breakdown lands in your feed. And if you know a friend, a sibling, a parent, or a neighbor in or near retirement who owns a home, has an IRA, or gives to charity, send them this video directly, because just one of these moves could keep tens of thousands of dollars inside their family that would otherwise have gone straight to the IRS. YouTube is also putting a video up on your screen right now because it thinks that is the next thing you need to see. Go ahead and click it. I'll see you in the next one.